When I was a boy, an old neighbor taught me something without ever saying a word. He kept a little garden behind a small house, nothing fancy. He planted, he watered, he waited, and every season he harvested more than the season before. No credit cards, no flashy cars, no declarations about getting rich, just a quiet, patient surplus. I didn't realize how rare that was until I watched people retire with big plans and bigger purchases, and then spend the next 20 years feeding the very things they thought would feed them. It's a strange irony. The older we get, the more we try to buy peace of mind, and the more it slips through our fingers when we buy the wrong things. Welcome to Quiet Wealth. Today, I want to talk about 8 assets that rich retirees almost never buy, and that struggling retirees often do. Not because people are foolish, but because the world is loud and salesmen are skillful. This won't be an angry talk. It's a gentle one, because mistakes in retirement aren't crimes. They're just expensive. I say this as someone who has lived through many seasons. I've watched market booms seduce and market winters humble. I've made my share of errors and learned slow, stubborn lessons. I've sat with couples who worried they'd run out of money when they still had plenty, and I've sat with others who thought they were fine until the true cost of their assets began to bill them like clockwork. If there's one pattern I've seen repeat, it's this. Most failures in retirement don't come from wild speculation. They come from buying things that look like assets but behave like hungry pets. If you've felt that retirement cash flow is tighter than you expected, you're not alone. The brochures never discuss the permanent drip of maintenance, taxes, fees, and time. The conversations at dinner rarely include the fatigue of managing too many moving parts. We're sold the idea that an asset makes us secure. It's not untrue, but many things sold as assets quietly do the opposite. Smart people get caught because the packaging looks respectable, because their neighbor did it, because the salesperson is warm and reassuring, because the calendar says, "You're retired now, treat yourself." This is not a problem of intelligence, it's a problem of human nature under pressure. Here's the reframe that helps. In retirement, an asset is not what a brochure calls it. An asset is anything that reliably gives you cash, options, or peace with minimal need to be fed. A liability is anything that asks to be fed, especially when the economy is thin. The label doesn't matter. A house can be an asset or a liability. A fund can be an asset or a liability. A business can be a steady well or a dry hole. Call it whatever name you like. The bank account will tell you what it really is. Let's use very simple math. Boring math. The kind I respect. If you have a $600,000 nest egg and your true all-in fees and asset upkeep are 2% a year, that's $12,000 walking out the door annually. That's $1,000 every month. Over 20 years, ignoring growth, that's $240,000. If that $12,000 a year could have stayed invested, even at a modest 5%, it would be roughly $412,000 after 20 years. This isn't impressive math. It's boring math. And boring math is what makes people wealthy or quietly poor. Now to the 8 assets wealthy retirees usually avoid, and why. I'll share what I've seen, the psychology behind each, the gentle math, and what the quieter alternative looks like. The first is timeshares and vacation club points. The pitch is always the same. A lifetime of memories, locked-in prices, flexible weeks, and maybe some resale value. The reality, in most cases, is a contract that wants to be fed forever. I watched a gracious couple buy one in their first year of retirement. It felt like a celebration. The maintenance fees started around $900 a year. In 10 years, they were $1,900. That's not unusual. A 5% annual increase doubles your fee in roughly 14 years. Meanwhile, the resale market for timeshares is like trying to sell a treadmill in a neighborhood full of joggers. The fact that it's called a deed does not make it an asset. If it requires cash every year and you can't exit easily, it's a pet, a long-lived pet. Wealthy retirees tend to rent when they want to travel. They like options. If they go to the mountains this year and the coast next, they simply book, enjoy, and walk away. No annual bill arriving every January like a property tax in disguise. The second is prestige vehicles, boats and RVs purchased as investments. I've heard it many times. These hold value, or we'll use it so much it'll pay for itself. In very rare cases, with income-producing charters or rentals, a boat can throw off cash, but that's a business, not a toy. For most, it's a money leak with a steering wheel. A new luxury car at $80,000 loses perhaps 50% of its value in 5 years. That's $40,000 gone before maintenance, insurance, and taxes. A modestly used, reliable car can cost you a fraction per mile and gives you the same freedom to visit the grandchildren. Boats are worse. There's a reason the old joke exists. The 2 happiest days of a boat owner's life. I like boats. I like the afternoon sun and the wind. But enjoyment is not the same thing as investment. Wealthy retirees separate pleasure from portfolio. They rent for a weekend, or they buy used and humble and keep it a short season. They use the thing. They do not feed the thing. The third is the vacation home you barely use. I know, this one is going to sting because it's tied to identity and family. I've seen the photos on the mantle. We'll make memories. We'll rent it when we're not there. Sometimes it works. But most of the time, the net numbers tell the truth. A $500,000 place with a 1.2% property tax is $6,000 a year. Insurance might be $1,800. Utilities $2,400. Routine maintenance $3,000. Reserve for a roof and big items, call it $3,000 a year amortized. You're at $16,200 before a single night slept. If you rent it, you'll deal with vacancy, management fees of 20% to 30% for short-term rentals, wear and tear, and the pleasure of replacing a dishwasher because a stranger broke it. That can be a valid business if you treat it like one and if you want to be an operator. But many retirees buy the second home as a symbol of arrival rather than a sober cash decision. I've watched wealthy retirees rent the same cabin every autumn for 3 weeks and walk away. They buy the time. They don't buy the building. They keep their capital liquid and compounding. The fourth is non-traded REITs and private real estate funds that pay rich commissions and lock up your money. Real estate can be wonderful. It can also be a velvet trap. A public REIT that charges a small expense ratio and trades daily is one thing. A non-traded fund with a brochure that promises an 8% distribution is another. Often, that distribution includes your own capital coming back to you. Add in sales loads of 7% to 10%, ongoing fees, and limited redemption windows, and you've turned your retirement cash into a hostage. I watched a gentleman try to exit one during a market wobble. The fund limited redemptions to 2% per quarter. He wasn't panicking, he just needed flexibility. He didn't have it. Rich retirees, the ones who've been around the block, like control. They like being able to sell a position on a Tuesday afternoon if they need to. They like low costs, high transparency, and simple structures. Illiquidity can be smart if the terms are great and you're truly prepared to hold for a decade. But buying an illiquid income promise because the yield looks higher than a bond is how people get trapped. The fifth is complex annuities with layers of riders and fees. I'm not against the idea of guaranteed income. For some retirees, a plain, low-cost, immediate annuity that simply sends a check every month can be wise. It's the complicated products that concern me, the ones with a guaranteed living benefit, a lock-in growth rate, market participation with buffers, and a pages-long prospectus that even the salesperson struggles to explain. I've seen fee stacks north of 3% all in. On a $400,000 purchase, that's $12,000 a year silently leaving before you see a dime. Over 20 years, we're back to the same boring math, and the promised upside often comes with caps, limitations, and surrender periods that make escape costly for a long time. Wealthy retirees buy clarity. They accept that markets wiggle. They build a cash cushion for the wiggling years. They match their spending to reliable sources: Social Security, a pension if they have one, bond ladders, dividends, and a well-diversified equity portfolio, the kind that gets boring over 20 years in a very good way. If they buy an annuity, it's simple, transparent, and used sparingly, as a floor under their lifestyle, not as a magic carpet. The sixth is cash value life insurance purchased in retirement as an investment. Life insurance is to insure against risk you can't afford to take, like losing your income while raising a family. It is not primarily an efficient investment vehicle for most retirees. The fees, the commissions, the early years of cash value going to expenses, these are features of a tool that has a purpose, but not the one often marketed to retirees. I've seen people in their 60s sold policies that will cost them $1,500 a month for a decade, with projections about tax-free loans later. The projections are not guarantees. If dividends and crediting rates change, if policy costs rise, if you borrow at the wrong time, the policy can devour itself and ask for more money. Meanwhile, a simple, low-cost index fund held for 20 years is not as exciting to talk about at a cocktail party, but it doesn't send you a letter asking for higher premiums to keep your death benefit alive. Wealthy retirees keep insurance simple. If they need it, they buy what they need. If they don't, they let go of it. They don't turn insurance into a hobby. The seventh is the bag of exciting investments your nephew or barber mentions: penny stocks, options, strategies, the latest coin whose name sounds like a cartoon character, hot biotech tips from a message board. At my age, I've seen a dozen versions of this. The promise is always outsized returns with a story so thrilling it feels irresponsible to ignore. But speculation asks for something retirees cannot cheaply give: the ability to be wrong for long periods without it affecting your life. If you want to speculate with a sliver of your portfolio money you can afford to see go to zero, fine. Call it entertainment. But when you label these as assets and count on them for income, you are scheduling an unpleasant conversation with yourself in the mirror. The wealthy retirees I know respect volatility, but they don't romanticize it. They're content with the slow, wide river of the market and the compounding of boring companies selling toothpaste and light bulbs and software licenses. They may own a few exciting names inside a diversified fund, but they don't pretend that excitement is a plan. The eighth is rental properties that don't cash flow, bought late in life. I love real estate that pays you more each year than it asks from you. I don't love a condo that costs you $300 a month after rent, simply so you can say you own rental property. I watched a couple in their late 60s pick up 2 units with 20% down, thinking rents would rise and carry the mortgage. Expenses rose faster, association fees went up, a vacancy at the wrong time, a water heater and a roof. That negative $300 a month per unit is $7,200 a year across 2. Over 15 years, before compounding or inflation, that's $108,000. If you had put that $108,000 into a simple index fund at 5% average growth, it would have quietly crossed $200,000. That is boring math. The wealthy landlord is a spreadsheet realist. They buy with a margin of safety on day one. They assume there will be vacancies, repairs, and paperwork. They either hire a manager and accept the reduced yield, Or they act as the manager and treat it like a job. They don't buy negative cash flow and hope for appreciation to bail them out. They do not go looking for an extra job at age 75. Notice the pattern. Each of these assets asks to be fed with either money, attention, or both. Each tends to be sold with a sheen of lifestyle or a promise of safety. The psychology is predictable. We're trying to buy certainty. We're trying to buy status. We're trying to buy belonging to a club or a story. We're trying to solve the single fear that keeps most retirees up at night, outliving the money. Ironically, it's the quiet leaks, fees, maintenance, complexity that cause the very thing we fear. A few hundred a month here and there becomes decades of small cuts. Those cuts interrupt compounding, and you interrupt the only real engine an ordinary person has to grow wealth. Let me give you another piece of simple arithmetic. If you spend $500 a month on asset upkeep that doesn't deepen your income or happiness, that's $6,000 a year. Invested for 20 years at 5%, that becomes about $198,000. At 6%, it's $229,000. The exact number isn't the point. The lesson is, money not spent becomes money that works. Money spent on fees and upkeep becomes memory foam, soft, comfortable, and completely non-compounding. So, what do the wealthy retirees do instead? They keep the garden small and fertile, fewer moving parts, boring funds with tiny fees, enough bonds or cash to sleep through bear markets. If they own real estate, it's with true cash flow and a reserve fund for when life happens. If they buy playthings, they label them as such and pay cash after the portfolio is properly fed. They don't outsource their thinking to glossy brochures. They ask 2 questions about any asset. Does it give me freedom or require feeding? Can I explain it to my spouse in a paragraph? If the answer to the first is feeding and the second is no, they pass. I remember a widower who did it right, though he never used those words. He sold the vacation condo when his knees told him stairs were now a negotiation. He let go of the luxury sedan and bought a plain car with a high seat and great visibility. He rolled a complicated annuity into a simpler plan when the surrender period ended. He kept an emergency fund that made him shrug at headlines. He planted his capital in low-cost index funds, some laddered bonds, and one duplex he owned free and clear with a long-term tenant who treated the place like her own. He had fewer bragging rights at parties. He had more coffee on the porch. He died with enough, but more importantly, he lived with enough. That was his wealth. There's a deeper layer to all this. It's not just math, it's identity. Many of these purchases scratch an itch we all have, to feel we've arrived, to feel we belong, to feel our life is still expanding in some way after work ends. The paradox is that expansion in retirement often looks like subtraction. Fewer obligations, fewer bills, fewer logins, fewer annual meetings. The big money is made in the waiting, and the big peace is found in the clearing away. Every contract you don't sign is a future afternoon you keep. Now, I'm not saying never buy a boat or a second home or an annuity. I'm saying know exactly what you're buying. If it's for joy, call it joy, and pay cash after the necessities of your financial life are already funded. If it's for income, demand the kind of paperwork a banker would respect. If it's for safety, remember that safety has a cost, and sometimes the cost quietly exceeds the benefit. You want assets that are more like that old neighbor's garden, planted once, watered with modest, routine attention, and then, most of the time, left alone to do what seeds do when they have good soil and time. Let's look at each of the 8 again with that lens of time. Timeshares promise decades of vacations, but also decades of bills. Over 30 years, even a $1,200 fee that grows at 5% becomes $5,184. You've paid $72,000 total, roughly, with nothing to show that anyone wants to buy. A long-term renter with a browser and a credit card enjoys the same beach, often for less, with zero strings. Prestige vehicles look like status. Over 10 years, they look like depreciation curves. The quiet car you pay cash for and drive for 11 years is an income machine. Every year you don't have a payment is a dividend you get to keep. Vacation homes are neither good nor bad. They're tractors. If you use them daily to produce something valuable to you, and you can truly afford them without stress, fine. But if they sit idle, they rust while billing you. In 30 years, $1 million invested at 6% doubles roughly every 12 years. In that same time, property taxes will double, then double again. One path compounds assets, the other compounds obligations. Non-traded REITs can be honest, but the fees are tall fences. Over 20 years, a 1% difference in fees on $500,000 is hundreds of thousands. Liquidity is an option, and options are valuable, especially when you're older. Pay attention to anyone who asks you to give it up casually. Complex annuities take a simple truth. Predictable income is comforting, and wrap it in engineering that transfers risk away from the issuer and to your own future returns. If you want a paycheck, you can create one. Ladder treasuries. Buy a simple annuity. Keep costs low. The more layers, the more mouths to feed. Cash value life insurance is a tool, but tools used at the wrong time are dangerous. In retirement, your risks have changed. You're not protecting 30 years of income anymore. You're protecting a spouse's comfort and your own dignity. There are simpler ways. Speculative picks are entertaining because we get to feel clever. Being clever is expensive if it's your strategy. Let your clever itch get scratched by a good book, a crossword, a grandchild's science project. Let your money be dull. Negative cash flow rentals are like growing a garden in the shade. You can try harder, or you can move the garden to where the sun is. If the deal doesn't pay you on day one, it's telling you a story you should believe. What will life look like if you avoid these traps? 10, 20 years from now, you wake up and the bills are plain. No surprise maintenance on the thing you barely use. No annual fee increases on the privilege of booking a week in May. No notices reminding you that you have 90 days to respond or your surrender charge applies. Your portfolio statement is only a few pages. You know every line. You could explain it to your grandchild. Your mailbox is mostly birthday cards, not glossy promises. You have mornings that belong to you. You go for a walk because you can. You help a neighbor with her fence because you have the time. You buy the good peaches at the farmer's market without glancing at a sale sign. On a gloomy news day, you shake your head, make coffee, and read a book. The dividends arrive. The bond ladder pays. Social Security shows up. The garden gives fruit, not fireworks, not headlines. Fruit. If you've already bought some of the things I've mentioned, this is not an indictment. It's an invitation to sharpen. Maybe it's time to sell something. Maybe it's time to cancel a membership. Maybe it's time to simplify a policy or transition a complex product into something plainer when the terms allow. Simplification is not failure, it's wisdom. The best investors I know become minimalists as they age. They prune. They keep only the branches that bear fruit. And they sleep better, which is worth more than another percentage point of return. And if you're tempted right now, if someone is offering an 8% yield in a world where government bonds pay a fraction of that, pause. Ask why the yield is so high. Ask about fees, lockups, and what exactly is guaranteed. Ask who gets paid first. Ask yourself whom you'll call if the checks stop. The rich rarely need to ask these questions because they've built a habit of saying no. That's their real advantage. Not secret investments, just a steady refusal to buy complexity. Here is how I've come to think about money. At this stage of life, money is not a scorecard, it's a tool for time. You want it to buy you mornings, not migraines. You want it to buy you dignity, not decorations. You want it to buy you the ability to be kind, especially to the people closest to you. If we keep that aim in mind, the expensive toys lose some shine. The complicated income solutions lose some allure. What remains is quieter but more durable. If you enjoy this kind of quiet, long-term thinking, you might enjoy what we do here at Quiet Wealth. You're welcome to subscribe. Let me leave you with a picture. Imagine two retirees standing at the edge of the same pond. One has a tackle box with 50 shiny lures, a motorboat, a borrowed son-in-law's advice, and a plan to try every corner by noon. The other has a cane pole, a stool, a good hat, and a sandwich. He's fished this pond before. He knows you don't catch anything by splashing. He knows the fish come to those who let the water settle. At sunset, the second one goes home with dinner, not because he worked harder, but because he asked less of the pond. Ask less of your money. Ask it to do a few simple, boring things, and let time do the rest. So, 8 assets rich retirees rarely buy: timeshares, prestige toys as investments, rarely used vacation homes, non-traded real estate funds with rich fees and locks, complex annuities, cash value insurance pitched as investments, hot tips dressed as assets, and rentals that bleed. If you can avoid these sirens, you avoid the rocks. If you've already steered too close, you can still turn the wheel. There is dignity in course correction. In the end, wealth is not loud. It is not a deck full of guests and a boat you don't have time to enjoy. It is not the boasting of distributions that are partly your own principal sent back to you with a bow. Wealth is quiet. It is groceries paid in cash, medical bills handled without worry, a grandchild's eyes when you say yes to a weekend trip, and a portfolio that hums softly in the background like a well-tuned engine. It is saying no to the complicated so you can say yes to the meaningful. Plant what feeds you. Don't buy what needs feeding. And wait, the seasons will take care of the rest.